Actually, once.
Oh, we're live.
Okay, cool.
Yep. What's up, guys?
Oh,
We're live with Kevin Green. And so, yeah, so, the last couple weeks have been wild. And also the first thing to kind of talk about is, we've really kind of had this nailed, and like I don't like to just say that. I like you guys to go back, check the other videos. We've been doing these all year long. You can go back, see the commodity reports, see the individual videos Kevin and I put together over time, and you guys can see, like, we're kind of painting a picture here. And that's what you do as a trader. Like, you're not, you don't know it's like asking someone to say who's going to be the best basketball player in the world in 20 years or something. Like, you can't do that as a trader. But what you can do is kind of put a picture together of what we're seeing, things to look out for. And, you could do that technically, fundamentally, however you want to put that together. And I think we've done a pretty good job of that. And so, going through it right now, commodities are down today. I think that was something I could talk about a little bit, because commodities being down today, everybody's going to go, okay, it's the end of that. Now we're into the new era of commodities being down, and then stocks will go up and bonds and everything's fine. And it's like, well, if you really paid attention to today, crude went down and then spiked back up, which is kind of very telling. And if you look at gasoline, like, none of these have really broken any major levels. You couldn't even say the short-term trends in any of these has changed. Gold, yeah, from 2,400, it's come down a bit, all the way, right now it's at 23.48. So if we look at that, you could say, okay, gold's come down a little bit. But when you have rallies to these degrees, like we're seeing these major rallies in the markets, we're seeing major rallies in all of these different commodities. Of course, we're going to see some major pullbacks at times. That's just going to happen, especially if you are a commodities trader. That very well. And so, also looking at cocoa, another one that if you take a look at, every time everybody goes it's over, it's not. And you just don't know when things are going to be over in these markets. And it depends on what type of system you're running, what type of strategy you're running. That's going to be the most important thing, and executing it and having that put together before you put on the trade, so you can kind of understand what you need to do, where you're going to go, and how you're going to position yourself going forward. But also looking at the commodities today, something that Kevin and I have talked about a bit, what is going up? Well, that's the ags. The ags are actually looking pretty good today. You have wheat leading the way with 4%. That's pretty wild. You have canola right behind it, almost up 2.5%. Lumber's up 2%. Feeder cattle up almost 2%. Natural gas up almost 2%. Cotton up over 1% today. So I mean, you have like this kind of rotation into these other areas starting to pick up. Corn, is one we talked about that we've been talking about for a while, and we're seeing that that's kind of starting to pick up. Soybeans starting to pick up. Really coming off of that double bottom around that 11,040 level. So it bounced double bottom off that 1140 level. Basically, the March lows were around that same point. Now it's turning around, making what you would call a V bottom, a W bottom. You could use that in Bollinger Bands or however you use that, but it's called a W bottom. And once we really break that 1220 level, that's how you get the buy signal from that. So, Kevin, what are you seeing in the commodity market today? What's something that our people should be looking out for?
Yeah, I mean, you definitely hit on a lot of them here. Let's go to the grains here first, because that obviously they're up on the day. You see wheat actually up around 4% in today's session. So a couple of developments that have occurred over the last week. One, you actually did see a fair amount of short covering when it came to the grain complex as a whole. And right now we are hitting a really key area of resistance when it comes to wheat. Let's see if we're going to be able to break out of that. But you are seeing some managed money trying to cover those positions, because now we are in the planting season. Now we are starting to see crops getting sown in the ground here. I think we're probably at around 10%, give or take. If you're looking at the aggregate here in the United States, the South is definitely leading the charge there. Where you're in the North, when you're talking about even Ohio or Iowa or Illinois, just starting to kind of get over that curve. They've had some volatility when it comes to weather events and things of that nature, but we're starting to get some seeds into the ground. For wheat, there is a concern about India and their ability to have a really strong crop season this year and be able to sustain their own demand pressures within their country, and if that's going to actually draw on international stockpiles. So we are seeing wheat kind of move up to the upside here. And then we also have corn and soybeans, as you're talking about. But for corn, Argentina is having some problems when it comes to disease within their corn crop. So much so that we actually have a disconnect between the USDA and some of the South American agencies out there, or even the private institutions that are trying to figure out what the yield totals are going to be for this year as far as harvests and things of that nature. So there's about 14 million bushel difference between what the USDA has, which USDA is on the higher end of that side, compared to what some of these South American agencies are looking at. So we're trying to figure out where are we going to meet? Are we going to meet in the middle there? Are we going to continue to have this gap? Is the USDA going to bring their estimates down when it comes to, especially when you're looking at the corn crop, or are we going to see this kind of reversal pattern? But the weather events and the fear of going from El Nino to La Nina is something that is pushing up grains, at least here for today. I also wanted to kind of talk about the oil trade, right? So we've had over the last couple of weeks a build up in inventory. I think 4 weeks or 5 weeks of build up in inventory. Nothing that just completely just shocks the street or anything like that. But we might be seeing near-term peaks when it comes to gasoline demand, which is fine to say the least. And actually, if you look at the gasoline to crude spread, it's widened out pretty substantially, meaning that gasoline continues to outperform as far as the price reaction here. But when you're looking at the crack spread, we are seeing a little bit of a deterioration, a small deterioration. Last week, Friday, the crack spread was sitting at $28.32, meaning 3 barrels. This is a very crude crack spread here. 3 barrels of oil being refined into 2 barrels of gasoline, 1 barrel of heating oil or diesel, or what have you, right? So we were sitting at around the $32 to $34 range, and now we're kind of breaking that lower, which is the reason why we were seeing a little bit of a sell-off. And then we had speculators in the market as well. And that once, I kind of talk about that late cycle type of behavior. I don't think we're full late cycle when it comes to oil in general, but we had a lot of speculators that were coming in, trying to make the move to the upside. Everybody and their grandma was talking about $100 oil, and that might happen. That might happen. But, once again, kind of check out the videos that we were talking about over the last couple of weeks. You're going to need to have a very strong catalyst in order for that to remain. And until we do actually have that catalyst that is very sticky, because the geopolitical catalyst right now is starting to abate. Right now, 80 to 85 continues to be a range. Would not be surprised if we do test, $78, maybe 77.5, and we would still be in the upward bullish channel that we've been trading in since December. So I actually like to see this shakeout before we actually move higher. I think we can have a little bit more of a room to the downside. Let's maybe even break the 80 level, really shake out everybody, and then try to go a little bit higher. That's going to be the energy trade. And then we talked about silver last week. I kind of talked about the producers were selling into that strength, right? That usually indicates a near-term top, late cycle behavior when it comes to that market. And we've been talking about that. We are seeing a pullback of about 5% today. I'm looking at 25.50 as an area of support. Maybe we rest there and try to push higher. But with a higher for longer narrative, we need to start having or continue to have very strong data across the globe when it comes to industrial production in order for that trade to be able to sustain. Because now we have some fears creeping into the market. Higher for longer is going to hurt the U.S. economy. We're going to slow a little bit. And if that is the case, then that's where we could see a little bit of a back off when it comes to oil demand, when it comes to the silver demand and things of that nature. So a lot that's going on right now. But those are the two items, or a couple of items, that I've been looking at, especially going into this week and the results that we saw from last week.
No, I love it. And I think, you also mentioned that was the conversation we had about silver the other week. While the trend is moving up and it is breaking out, starting to move higher, you mentioned in the short term, we'd probably see some volatility. That was a really good call. And, obviously we did, and we saw some volatility. And that's the thing you have to understand. There'll always be for me, there's always three different trends. There's a primary trend, intermediate trend, the short-term trend. I mean, that's just basic old school Dow theory stuff I learned years ago that I've always kind of stuck with. It's kind of been my bread and butter for many years. It kind of helps me to digest what's going to go in the market. Most of my trades are on the intermediate term trend. So as the intermediate term is still moving up, you can have this short-term volatility and these short-term pullbacks that are going to come in the meantime. Now, I really like the precious metals as a long-term trade. I think it has a lot of value going forward. However, in the short term, we are seeing extremes in the producers are starting to buy back or pull back on buying. The hedge funds are starting to get a little bit too bullish. The retails are getting extremely bullish.
Yeah.
These are things that create pullbacks in the market. And once those get shaken out, and that's what Kevin's also meaning by the oil trade, like we need to see that positioning get shaken out a little bit to move higher. This is what creates trends. Now, you really can't just have a trend that just goes straight up smoothly. And the reason is because of that. They don't go up smoothly because most people aren't just on the offside the whole time, like cocoa trade, for example.
Yeah.
Nobody really got extremely long on the hedge fund side, the retail side. The commercials continued to buy, but nothing was at extremes, and it still hasn't. If I bring it up, so I'm not just talking here. Let me bring it up.
Yeah, and I got an interesting stat for you for the cocoa one too.
Yeah, so we'll talk about that too. But if we look at it, commercials are still continuing to buy. Retails and hedge funds are still continuing to pull back on buying. So that's kind of telling me that the cocoa trade still has legs. Now, most people look at things and they go, well, like, oh, if you look at the chart alone and you say it's parabolic, it's moved a lot. Yes, you could say all those things, but how do you do it in a way that's sustainable so you can still continue to trade well? Well, you got to either understand the positioning. The positioning is always going to be the most important factor. Short-term traders use order flow, options data, all this stuff. Long-term traders can use things like positioning data from COT reports. Kevin and I look at those a lot. And so when you're looking at that in the cocoa chart, which I'm pulling up right now for me, I could pull it up for everybody else and share it in a second. But if we're looking at this cocoa chart and we're seeing that commercial buying, or they're still buying on the way up inside of a major trend, most of the time that's not going to end anytime soon. But if you look at something like silver or gold, which we talked about last week, that was the opposite. So I think it's incredibly important to kind of pay attention to the positioning in all of these markets.
Yep. So Die Hard band, like this is what my reports look like after I'm done reading them. It's like people have no idea. Like I probably read like 10 to maybe 15 reports every weekend. So they go through some damage to say the least. But here's actually a very fun fact, because I'm right there with you when it comes to the cocoa trade. There is some short positioning that is taking place, but here's the context of it, right? Over the last 52 weeks, what we saw last week in the Commitment of Traders report was the largest short position that we've seen in the last year. Now, let me put that into perspective here. The shorts increased by 614. Well, hold on, I'm sorry. Shorts increased by about 150 contracts net, right? And then long positions actually were reduced by 614 contracts. That's 700 contracts. And that 700 contract move just brought you to your 52-week like high if you're talking about short positioning, which means, and when we talk about that, we're kind of laughing because when I say, hey, that's in the 52-week ranking, it's number one short positioning for cocoa right now in the 52-week ranking. And all it took was a 600 contract change in that positioning. So, which is not a lot. Let me just kind of put that in focus. That's not a lot at all. So the longs continue to be fairly long on a longer scale standpoint, even though we are seeing sellers starting to creep into the market. It's already moved the positioning to that 52-week. I call it a 52-week high. Let's see, 52-week high when it comes to that net short. That's crazy. It's also a thin market to say the least here. So are they structuring to come in and maybe sell off some of these contracts? Yes. Is it something that's going to completely unwind this trade over the next couple of days? Probably not. And so you kind of ride trends until you do. But you always be mindful, like, yeah, we did see a little bit of a net change last week. It's like 614 net contracts changed last week in cocoa. Good to know. But on the grand scheme of things, knowing that you just went from completely overly long contracts and seeing a small decrease on a week over week basis, and knowing that that just shifted you all the way to the shortest positioning that you've seen over 52 weeks shows that there's still strength in that contract. So I thought that was very interesting. I wanted to bring that up to you today because it was funny to me. Usually when you see these large swings, you go from very long positioning, the net short position, you're talking about thousands and thousands and thousands of contracts in order to change that sentiment. You're not talking about 614 contracts. So that's where you have that difference there. What I will say, though, I'm a little bit concerned when it comes to the metals in the near term, but I think there's still an opportunity there from the reflation trade and from the fact that we are seeing physical demand in some respects. Now, people also have to realize silver is not as much of silver is not as scarce as maybe some of these other metals are. So the silver market can actually meet demand if demand wants to hang out for a little bit. That is something that can happen. In the near term, I think we do see a shakeout for silver. $30 is really hard to break. 27.50 to 28.50 is what I was looking for as far as an area of resistance that's been able to serve here. Wheat market, when you're looking at the 52-week ranking, this is from a high tower report too. Looking at the 52-week ranking, largest net short positioning for wheat, Kansas City wheat. There's several different wheat contracts. There's Minneapolis wheat, which is the wheat that we don't actually export. That's kind of our finer type of grain. If you're talking about the wheat market, that's where you're making your artisan breads and all that stuff. So we actually don't even import or export pretty much any of that on a grand scale, on a big scale. We export the Kansas City wheat, the Chicago wheat, things of that nature. So, but short positioning is still fairly large, even though we're seeing a 4% move today. People are still net short that contract. And then I wanted to also bring up sugar. Sugar is also seeing a high net short interest as well. So, we have a lot that's going on this week, Jason. I would say that what I'm kind of focusing on is obviously the dollar move. Do we see the dollar moving to back to the downside here, or do we see a little bit of a breather in that space? Do we see a breather in yields? Not popular. We don't have that many popular treasury auctions this week, but we have critical auctions this week. The 2-year treasury is probably going to be that nail in the coffin. If that one fails, that is the nail in the coffin for us to be able to drop pretty significantly, in my opinion, because that has been rolling up higher. Yep, you got that chart there. Could actually be a little bit like they try to be a head and shoulders pattern. That definitely failed out, but we are approaching some resistance here. Also, just note too the weakness that we are seeing in the Canadian dollar, the weakness that we're seeing in the euro, the weakness that we're seeing in the yen. All of those things continue to trend in a scenario where the Fed might be the last one to cut. So something's got to give. It's either going to be the dollar, is it going to be the yields, or is it going to be the macroeconomic landscape as a whole? I think that's going to be the dilemma that we see over the next couple of weeks. What do you think?
No, that's great. And honestly, it's funny because like the charts we're talking about is like all the things that you're bringing up things that I was like, I want to talk about these things today. So that's perfect. Because it's like, when we're looking at so many of these different products, it's always important to understand all the sides of it. And even like you look at positioning changing, it's always important to understand like too, what ends up creating these major trends. And most of the time, the hedge funds, if we're looking at this chart, I'll bring it back up so I can talk about it in a way. So because it's hard to understand COT reports. People ask me this all the time.
I know. I nerd out on it all the time.
You and I have a great video actually. Yeah. If you go to our page, it's like it's exactly. I think it's called "How to Read COT Reports," and like we go through it. So please go check that out, and you'll kind of understand what we're talking about. So this is the cocoa chart. We're talking about positioning. We're talking about the changes in positioning. So let's make this really simple without even talking about the numbers. Most of the time when you see changes happen, you have to understand every contract. So most of the time the commercials, these are the people that are producing cocoa. because they're producing cocoa, most of the time, they're not going to be on the long side to a major level most of the time. Most of the time, they're hedging themselves. So when they get long, that's a significant signal. So you'll see here, there was a rally out of this one. There's obviously the ongoing rally out of this one here. So that's significant. And then when we see short interest get to major highs in the commercials, then you go, okay, well, maybe the rally's stalling out a bit. Maybe something's changing. But what's interesting about this one is that the commercials continued to kind of get long as we've been in this rip-roaring rally, really, which tells when I see that usually tells me that the producers, meaning the commercials, they see something that we can't as traders. They're seeing that, hey, we have a supply problem here. And so because of that, they're going to continue to buy on the way up and see value in prices as they're moving up, which is very rare. So this kind of sustains trends. However, you can also see the other situation happen at times where, you'll see the buying continuing up as the rally continues, like in this part right here. So the buying continued there, the rally continued there. So it's important to understand that you have to, one, I only look at the major extremes, for me at least. My time frame, I'm in this trend. This is the trend I'm in. This is where we got the buy signal. So because of that, I'm only looking for these major extremes, and then major extremes the other direction. So when you see those major extremes, you can kind of go, okay, I should be buying. I should be looking to sell. I don't just sell on major extremes. I might move up, tighten a stop loss using a systematic method. But most of the time, I'm going to continue to hold those trades when the trend is up, because the only time this really, really matters is when it hits major extremes. And so, like we said here, the buying part, the extreme selling part, like those are important things. So for me in the cocoa trade, to see where we're kind of still heading, even though there's a little bit of shift in positioning, I would still say that there's possibly more upside. And most importantly, above all else, let's say like we don't have any of this data. We're just looking at, we put on the trade, we're in cocoa. You don't want to get there's a lot of people trying to short it right now, which I find kind of crazy. But if you're trying to short, it's like jumping in front of a train. Like you're probably not going to outrun the train. There's no reason in trying it. So I would literally, like, if you have the trade on, great, keep moving up your stop as you go along. Use a trailing stop, however you do it. Be willing to get out at some point. However you do that, that's fine. But I wouldn't for example, I wouldn't buy here. I wouldn't try to short it here. I wouldn't do anything here, for example. So just some thoughts on my end on that.
Yeah. So you brought up some really key points there. So we kind of, and if we can actually, are you able to bring that chart up just real quick? And then I want to just kind of show what. So we had basically managed money is now trying to, our large speculators are now trying to kind of liquidate or lower their positions. You have the producers moving their positions up. So here's, and then that's all I wanted to really show. Here's the reason why that the producers are moving that up. So there is a supply chain issue that is occurring right now. Now in Ghana and in the West Ivory Coast, from what I'm reading, they're actually going to stop deliveries for this year for a lot of their contracts. They didn't cancel the contracts out though. They are committing to actually delivering them in 2025 at the beginning of the year. But they're just going to stop a lot of they're going to stop the deliveries of what they have under contract for right now because of the situation that is occurring. You also have to understand too, the farmers see this as an opportunity. Yes, there's an issue with growing, but the farmers are now hoarding their supplies and they're basically just waiting until they can flood the markets. And in some instances, they're actually skipping on fulfilling contracts as well, which is very risky to do. You fail to deliver on a contract in commodity markets, that could literally destroy your reputation in the industry here. But there's so much demand that people are kind of overlooking that right now. But they are expected to actually start supplies back up and supply these contracts in early 2025 or for the delivery year of 2025. So that should actually bring some downward pressure for them. So what they really are trying to do right now is just build up as much inventories as possible instead of trying to have this just in time. They just want to like get everything together and then just do this huge supply push in the market. Once that happens, that's where price will push down. That will occur, barring any type of damaged crops, a silo or whatever catch fire or something like this, something crazy. There is an end in sight here. It's just not now yet in the price action. So that's just another thing to kind of note as well. But it's a hell of a trade, man. It's a hell of a trade, and the situation behind it is what's really interesting. So you talked about, so producers usually don't go net long, or usually don't go long contracts a lot. If they are going long, they may have an offsetting short position in order to offset that, and maybe they do believe prices are going to go up, so they want to kind of relieve themselves from locking in prices and then try to get higher prices, right? But when you start seeing producers going net long, that generally means that there is a supply shortage and they may not be able to deliver. And a lot of times, if you're not able to deliver a contract, they can go long a physical in the hopes of being assigned on that, right? Or they could have a situation where if they're not able to deliver, usually it's a cash payout that you have to pay for that contract. So that's what they'll do as well. They'll go long, they'll offset it. They might default on a contract and they say, okay, well, here's the settle value for it. And that's complete nitty gritty stuff. I mean, we saw that when crude oil went negative, was kind of the same situation in a or not. Sorry, we're not when it went negative. When we had the Ukraine-Russia conflict, and the supply lines were all messed up, and a lot of these energy companies just didn't know how they were going to deliver the physicals, so they also went net long along with the overall market too. And the reason why they did that is because they knew that they were going to have to eat some of the cost on the penalties of being able to fail because of failing to deliver the physical, right? And so usually if you fail to deliver the physical, you have to pay the cash value in order to settle.
No, I think it's so important because you have to understand each contract too. We should also say that other contracts, certain commodities, like they are net long at times, and a lot of the time, but it's rare that you find commodities that are like that. Most of the time, they look very similar to the chart we showed of cocoa. Gold's also the same way. You very rarely see net long in gold. Like that's also something you don't see much. So it's kind of very, it's dynamic and it's something you learn over time. But if you just base it on one simple fact, look for the extremes. The extremes are going to tell you trend changes. The extremes are going to tell you when you should be taking buy signals. And if you can find things like the extremes in the commodities markets, you can figure out ways to perform using the commodities, which it obviously can be very profitable. The cocoa trade's a 1 in a million. Like I don't know if I'll ever see a trade like that again. It's very.
Oh, you will, man. You're young. You're a young guy.
I've seen huge moves. 2020 we had great years. We had some amazing moves. I've seen some huge moves in the commodities markets over the years. I don't know if I've ever seen a 200% year-to-date move in the first quarter. I don't know if that's ever happened. So I'm more saying I don't know if I'll ever see something that crazy. Trading wise, there's always another trade and there's always things that move, and that's cool. But something like cocoa, where it's hey, we're 200% year to date. I don't know. It's cool. It's great. But and commodities are like that. I'm not saying we don't see moves like that. We see tons of moves similar all the time.
This is a 3 standard deviation.
Yes, this is wild. So once again, it's find the extremes, continue to look around all of these markets for different ones, and understand it's just one trade in a million. So continue to look at all the other commodities together. And also what we're talking about in the COT data, another important thing is what we're talking about, the ags. We've been talking about the ags for a while. I've been posting on my newsletter for a while about the ags having extreme commercial buying. Nobody seems to care until the price starts to move, which is exactly how it should work. But right now it's they are set up to move in a very similar way. It's kind of like coffee was also set up to move recently. So I think the ags are kind of the next space where you'll see this crazy amount of buying turn into a trend at some point soon. But once again, it has a lot of things to do with it. Like Kevin brought up earlier, the dollar is also incredibly important in this. Let me see if I can find that chart again. I always pull up the wrong one every time. There's energy and there's okay. So the dollar, I think this is also the key component of what we are looking for as traders right now. So the dollar to me is always the most important thing because it can tell me what regime I'm in, what type of market environment I might be in. Am I going to see pullbacks? Am I going to see volatility? So the dollar tells me a lot. And now it's kind of getting up to this resistance zone. And it's within, and usually I create bands. I subscribe to the idea that resistance shouldn't be drawn in a line with a pen. It should be drawn with a crayon or a marker, meaning it's wide. And so looking at this wide band and this wide area, this is where I'd be looking for a reversal in the dollar if it's going to happen. And vice versa, if it starts to break out the other way, I'd say, hey, maybe we're heading into a very different regime here. Maybe we're heading into a more deflationary style regime. So looking at all these things is incredibly important. We need to keep an open mind to all the different commodities, how they can move. The macro right now is the key, I think. More than anything else, the macro is probably how you're going to navigate this market well at the moment and see where you're going forward.
Yeah, I agree. I mean, right now, if the dollar does break that upper resistance line, you're making higher lows, right? You're making higher highs on a relative basis. That's not a really good sign, to say the least here. But one thing I also believe that we are seeing the strength in the dollar is because of what's happening in yields right now. And so, once again, these relationships and these correlations haven't been normal over the last couple of weeks, 4 weeks, 5 weeks. And at some point they will break and correct. And it just depends on which one is going to correct the most. From the agricultural space, yeah, they're going to benefit from a lower dollar. That's going to put us at a little bit more parity when it comes to the global markets and the shipping and the demand picture that is out there. We also do have a problem, though, when it comes to China. China is really trying to diversify itself away from the United States. We are seeing it pretty much in all the spaces, but you're now starting to see it in the soybean market. And China's probably, if not, is the largest soybean importer in the world, if I'm not mistaken, when you're looking at the actual beans themselves, and then also when you're looking at soybean meal or the already crushed beans. And they use that for livestock and personal consumption and things of that nature. So that shift, I think, is something that maybe the market did not price in that it would be that aggressive quite yet. We knew that this transition was going to happen, but maybe this kind of got a little bit more accelerated after we started taking assets from Russia, started to sell them, utilizing them to fund certain proxy wars and all this other stuff too. So I think that's really where you're seeing the headwinds when it comes to grains. It's the inventory levels that we are at right now. It's also the fact that South America is kicking our butts when it comes to pricing. They have the better prices right now. Now, are they going to be able to fulfill? That's going to be the big question that we won't really have an answer to for another couple of months here. But I'm right there with you. I think there's certain pockets there that can actually rip to the upside when it comes to grains. If you're looking at the whole commodity space right now and you're looking at the positioning, you're looking at the charts, though that market risk reward on a risk reward basis probably has more upside reward than downside potential risk right now. And I believe that wholeheartedly here. Also, kind of looking at the yield structure. So if we have this higher for longer scenario, does that also cause a little bit of an economic slowdown going against the grain of our reflationary trade? We don't have that data yet to really confirm, but I think that's something that we need to keep our eye out on. And I'm not saying we're there yet, but last week was a little bit odd when you're talking about the price action for oil. Did we have to come down from $88, 87 and some change? Yeah. But to kind of see this rapid move floor based on the geopolitical events does seem like maybe some speculators got too overly ambitious on the upside, are now just flattening out and washing out. That hopefully that is going to be the case. But I started thinking about it over the weekend. I am a little bit concerned that maybe we have this slowdown narrative that does creep into the view once we get to the latter half of the summer season, right? So August, September, October. and I was talking about this in the spaces earlier, the Fed, everybody's kind of like pricing out the Fed cuts, and rightfully so in some respects. But the Fed does have this weird, they will have this weird base effect window between like August and September, let's say October, right? It would be for the August data set, the September data set, which then October will get the September data set, where they will have some deflationary pressures in the works here, and they could kind of maybe say the trend's back on, and maybe they do cut rates. But I think that there is the reaction in yields does appear that the market is preparing maybe for a little bit of a slowdown. I don't know if we get there. The credit markets right now are starting to widen out as far as the spreads, lack of liquidity in the marketplace, kind of seeing that domino effect. Does that actually have an impact on the consumer going into the summer? I don't have any insight as to yes, no, or maybe, but I think it is something that we have to put out there that could be a potential risk for these bull trades that we've seen in the commodity space as a whole. And maybe we start getting a little bit more of a normalization, if you will, when it comes to prices, which I think is good, which I think is fine right now.
No, I agree. I think that the things I wanted to also talk about a little bit was just the reflation trade in general. So when we look at the reflation trade in general, there's a couple things that's interesting, and the reason why I'm getting two different signals on my model. So I have a technical model and a fundamental model. Both look at just macro data. Both of them are kind of between two different regimes right now, and that's a stagflationary regime and that's a reflationary regime. And so why it's interesting is that gold doesn't usually do this well in a reflationary environment. Most of the time yields are rising. Gold really doesn't like real yields rising at all. So when this is all happening, it's kind of odd that we're kind of in this environment. So what I keep saying is we have to look at the different sectors across the market, the different things in the macro environment, meaning things like financials and utilities. Like utilities started to pick up a little bit last week. If that starts to continue, I would say, hey, maybe we're kind of seeing a more defensive posture going forward. But the thing that I keep seeing, and I'm going to talk about this in my letter today a bit more, is I keep seeing where we continue to just stop at these zones. This is small caps. That's the dollar. We already went over that. But once again, it's kind of also pointing to the fact that, hey, maybe it stops here, stops sometime soon, starts moving down. The dollar is putting pressure on the market. That's why I'm saying it's in an uptrend, and it's working the opposite way than the sectors we're looking at. And so when we look at energy, it's the same thing. We're coming to those highs. We just retraced back. Now it's moving up again today. And then financials, finally. We broke out of those highs. We've come back. We're kind of finding support in these areas. So we're seeing that kind of across the board at the moment. And the important thing to watch here is going, okay, well, the primary trends and the intermediate trends are all very solid in the sectors we just listed. Include also industrials in that if you want to. The primary trends in utilities, it isn't anywhere near that. The primary trends, the intermediate trends are still down. We're seeing some retracement rallies in the utilities. So I still think the reflationary trade, where the growth-based commodities like copper and oil and these things are going to do better in this type of environment, I think that's still holding up really well here. So I think it's important to keep an eye on this because, like Kevin said earlier, relationships change. And intermarket analysis is more of an art than a science to me. So because we're looking at all these markets and across all of these different things, I think it's going to be really of the utmost importance right now to handle the data you have and continue to update and be flexible here. Like people in trading, people get too rigid in what they believe. Like if I could tell you for sure, I'm not going to have a thesis about cocoa. If cocoa is crashing here, I'm not going to have a thesis that it should go up for some reason if I get a sell signal. And so you have to continue to go, okay, well, we do see these primary trends. We do see these intermediate trends. These are holding up. The market should do blank. However, if this happens, like utilities start to move up, let's say bonds start to get very strong here. And Kevin also talked about the dollar. The dollar also starts to get strong here. And I also believe, as Kevin was talking about earlier, I call the dollar the panic currency, because most of the time it really goes up very well when you see a lot of panic in the world. That's kind of the time you want to own dollars over anything else, and it creates those huge dollar spikes and so on. So people are kind of panicking into dollars right now. Makes perfect sense. And if it's more than panic, we're going to see it in that breakout. It'll continue higher. But for now, like, I think everything's kind of based on a little bit of panic, a little bit of fear in the market, and the commodities and the inflation trades. All those sectors are holding up much better than everything else. So I continue to think our thesis on commodities starting to move up, especially these growth-based commodities, and even gold and silver, copper especially, those doing well. The sectors that we like doing well, like energy, I think that's going to continue to do well in this environment. And so we're going to have to just see where that ends up. It feels like my cat is timing as I'm talking. I don't know if anybody can hear that in the background, but my cat is literally, every time I start to talk, my cat's like, I need to eat.
So that was kind of like the thesis of my little like market prep that I write every week, right, on Mondays, or try to drop it on Mondays.
I'll put that in the comments as well.
Oh, for sure. I appreciate that. And it's about 1 second. Oh, it's about preparing, right? I kind of like compare. I wanted it to be a lot longer piece. So it's actually going to be a 2-parter, because I was like writing yesterday. I'm like, there's no way somebody's going to read a 4,000 word piece right now. Like, that's just not going to happen, right? So I had to break it up. But it's all about the preparedness side of it, right? And we know, like, preppers, they focus on, maybe natural disasters that come through, or they have economic turmoil, or what have you, right? Or even personal events. And so you have people stocking up, getting prepared, and they're buying things in order to be able to sustain themselves in the future, right? The things that they buy may not be the immediate gratification, or you don't see immediate return for a lot of those products. And I think the market has this also type of preparedness type of mantra that is going on right now. I mean, we have some geopolitical events that are occurring. We know that we have some events happening at the latter half of this year, the election cycle that's going on. We have weather events from El Nino to La Nina. We have all of the stuff that's happening. And yes, tech has been a really good performer, and they have been able to do so. But sometimes when we have these kind of conversations, you have to think about the beta, or the risk that you have compared to the reward. And so kind of going on that thesis of maybe the Fed does mess up. Maybe the Fed does go higher for longer in a scenario where we don't cut until next year. The reflation trade has been a nice one. I'm not saying I'm getting off that bandwagon by any stretch of the imagination. I think that we're still early at it. But I'm a little bit, if you asked me the same questions that you would have asked me 3 weeks ago, knowing what I know now and what I'm seeing right now, I would be a little bit more cautious on that reflation trade. Can we have a stagflationary environment? Definitely. Like, that can occur, but we won't be able to call that until like February or March next year, if you're a really good analyst out there, right? You don't want to jump the gun, because we know that the job market and the labor market is a very lagging indicator, a lagging market, to say the least. And once we start seeing that pick up, it takes a long time for it to kind of reverse or reset itself. But highlighting the utility relative strength that we saw last week, utilities usually do not perform that well when interest rates go higher. And I'll just give you the straight up base case, because you can go into the fundamentals and say, they're very capital intensive. They have a fair amount of debt on their books compared to a lot of other sectors that are out there. They have interest rate risk, but their dividend yields are not as attractive as, say, an investment grade bond or a treasury. And so right now, if you look at the XLU, which is not a great ETF, constructed ETF by any stretch of the imagination when you're talking about the utilities, because NextEra is like 13.5-14% of the overall ETF. That's not great. But if you look at it, I think the yield right now is sitting at around 3.3%. Or you have treasuries paying 4.5%, or even if, I can't talk about my trades. There was a 3-month treasury bill that's going out there right now paying a 4.5% yield. Now it's 3 months, granted, but you have to keep all that type of stuff in mind. And so utilities usually don't catch bids in that market. Last week we saw that. we saw a little bit of a bid. And I don't know like how dynamic your charts are, but if we had an XLU chart and we brought up a weekly chart on a 3-year or 5-year basis, I'm asking for a lot. I could probably just send you the thing. The 200-week moving average has been an area of support in the past. It has now been an area of resistance for the XLU, and we're testing it literally right now today. We are testing that level. If we can break out of that weekly resistance area on large volume, then yeah, we might see a breakout to the upside. And money managers, they're under allocated towards utilities. They do have the ability to have stock appreciation. If you look at their input costs, they've also gone down. So let's talk about the natural gas utilities that are out there, even utilities gas piped, and then also those utility companies that utilize natural gas to be able to generate electricity. Those input costs have gone down considerably. We talk about Natty all the time. It's like it's a very hard trade because everything in your heart says, man, this thing needs to rip, but it just does not. So the input costs for a lot of these utility companies are coming down, but when you're looking at their pricing that they are putting on the consumer, they continue to rise at actually a pretty healthy clip. So their margins are expanding. And so is there a prep trade here where you say, you know what, we've seen some equity volatility, the tech is getting sold off here, I still need to have exposure, how can I pull, is there an area? Utilities might be that. Now, once again, that downtrend is it's a heavy weighted downtrend, but that break to the upside could be something that would be significant. I talk about the same thing when it comes to the consumer staples companies. And then people are going to be like, well, man, consumer staples right now, they're getting squeezed on margins. In a reflationary environment, what do consumer staples usually have? Pricing power, right? If they're seeing prices increase, their prices increase on the materials that they are obtaining, on the products that they're trying to sell, and wages continue to rise at a healthy clip, they will pass that on to the consumers. Companies are not shy in order to do that. And I think that would also be something that does expand. I also believe that we will have a seasonal trend going into an election year where consumption rates for consumer staple goods will increase towards the latter half of this year. And I think that will be a tailwind for the staples. And staples are performing fairly well here today. Mind you, yeah, the chart looks like it could continue to move to the downside here, but just mind you here, this is not a this week or next week thing. This is something that's preparing for the latter half of this year when we know that we have things on the horizon. If you look at the VIX futures curve, October VIX has spiked higher than any other contract in the near-term contracts here, even though farther dated. We don't have any Fed meeting then. We don't have any elections at that point in time. So why are we seeing it spike? We're seeing it spike because of the anticipation of volatility at that particular event. And then we continue to price that out. It has not gone down at all. I think that there is something that might be on the horizon. We know what's on the horizon. I think that would also be a tailwind for these areas of the market that have very low beta, low correlations to the broader S&P 500. Could be a flight to safety here. It will not, I'm not going to say never. Traditionally, utilities will not outperform pretty much any sector, maybe outside of real estate. Staples, they're not going to be you're not going to get tech type of returns off of any of these names at all. But we talk about risk reward and where can flows go into, and that's where I've been actually looking at them this week, knowing the dynamics that we are seeing. Counter trend dynamics, especially in the utility space compared to yields, is something that you have to be mindful of. Does it last? I don't know. I don't know if it's going to last, but it looked pretty healthy last week. There's only two sectors that got inflows all last week. Last week, we were down a lot on the S&P 500, the NASDAQ, the Russell. The only two sectors I saw inflows, utilities and staples.
No, I completely agree. And also, I do have to say, as a sector trader, I do have plenty of times where I get into utilities and consumer staples. Go back to 2019. It was a great year for both of those. Basically, the kind of deflationary trade, we weren't in an environment that was like risk off per se, but we're in kind of a deflationary style risk on environment. And so being long consumer staples, utilities was the play at that point as a sector trader. So we were long those and we had really good performance that year and we outperformed the market by using those. So there are always times to buy all of these different things in these different sectors. And right now, we could easily shift, like we're both talking about, like we could shift between regimes very easily. And that's what markets do. They shift. Like they don't, it's cool that everybody got the tech trade and it sounded really exciting. And that must have been a lot of fun for people. However, we could also shift into a different environment. And now we're either going, we've been in kind of a reflationary environment, and we could go stagflationary, or we could go, basically growth or inflation down with growth moving up. That's another environment that's called Goldilocks. So we could go into any of these environments right now. The key right now is to continue to watch the market, continue to watch the prices, continue to watch the trends, and be open to new dialogue. And we'll be back next week to kind of tell you guys how we're going to be positioned going forward. But for right now, inflation trade for me is what I'm still seeing, but I'm being cautious about the things we talked about. I agree with Kevin on that fact as well. So, all right, guys. Well, thanks for joining us, and we'll talk soon.